Your salary, your home price, your investments, all of them are being quietly controlled by something you've probably never looked at. Not your boss, not your bank, not even the government. A market worth over $100 trillion, the bond market. And once you see how it works, you'll realize it's been making financial decisions for you your entire life. Let's start simple. A bond is just a loan. A government or company needs money. Instead of going to a bank, they borrow from investors. You give them money today. They promise to pay you interest every year and return your money later. That's it. No complexity, no mystery. But here's where it gets powerful. Because when interest rates change, everything changes. There is one rule you need to remember. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. Always. No exceptions. Imagine this. You buy a bond that pays 3% interest. Then suddenly, new bonds start offering 5%. Now your bond looks terrible. Why would anyone buy your 3% bond when they can get 5% somewhere else? They wouldn't. So if you want to sell it, you have to lower the price. That's how losses happen in bonds. Not because the bond failed, but because better options appeared. Now, zoom out. This isn't just about investors. This rule affects your real life. Let's talk about your biggest expense, your home. Banks don't randomly decide mortgage rates. They look at one thing: government bond yields, specifically long-term bonds. Because here's their logic. Why should we lend money to you when we can lend to the government risk-free? So they add a margin on top. That's your mortgage rate. Now, watch what happens. If bond yields rise by just 1%, your home loan becomes dramatically more expensive. Not slightly, tens of thousands more. Same house, same buyer, same income. Only one thing changed: the bond market. And it doesn't stop there. For decades, people believed something simple. Stocks grow your money, bonds protect it. That's why portfolios like 60% stocks, 40% bonds became the default. Bonds were the safe part, the seatbelt. But in 2022, something broke. Interest rates rose rapidly. And remember the rule: when rates rise, bond prices fall hard. So bonds didn't protect portfolios. They crashed alongside stocks. The safe side lost heavily. The seatbelt didn't save anyone because the crash came from the thing bonds depend on: interest rates. Now here's the part most people miss. Not all bonds behave the same. There's a number called duration. It tells you how sensitive a bond is to interest rates. Higher duration, bigger swings. So if rates rise by 1%, a short-term bond might lose a little. A long-term bond might lose a lot. Same asset class, completely different risk. And most people investing in bonds have no idea what their duration is. Now, let's go deeper. Because the bond market doesn't just react, it predicts. There's something called the yield curve. It shows interest rates across different time periods. Normally, longer loans pay higher interest. Makes sense. More time, more risk. But sometimes, short-term rates become higher than long-term rates. This is called an inverted yield curve. And when that happens, the bond market is sending a warning. It's saying, we expect the economy to slow down. We expect rate cuts soon. We expect trouble. Historically, this signal has appeared before almost every major recession. Not sometimes, almost every time. So while people argue on the news, the bond market quietly moves first. Now, let's bring this back to you.
Right now, your money is sitting somewhere, maybe in a savings account, earning almost nothing. Meanwhile, short-term government bonds might be paying multiple times more. Same safety, different return. The difference isn't risk, it's awareness.
Because the bond market doesn't just affect investors, it affects your loan payments, your job market, your investment returns, your savings growth. It's the invisible engine behind your financial life. And the people who understand it don't have secret information. They just understand the rules. So next time you hear interest rates went up, don't ignore it. Because what that really means is your future just got more expensive or cheaper. The bond market doesn't send you a bill, but you pay it anyway, every single day. And now you finally know why.